Partners. Josh, thanks for joining us.
My pleasure.
First off, could you tell us a little bit about Stonecastle?
Absolutely. Well, Stonecastle Partners, which is our holding company, we are an investment firm, first and foremost, and all we do is invest in banks and predominantly community banks. We have never dabbled in other things. We don't want to. And I don't know if it's still a fact, but I believe it's still a fact that we're the largest investor in community banks in the country. Today, we manage a little over $6 billion of assets in total across a variety of different vehicles. Some of those are securitizations, some are hedge funds, and now we have our new public company, Stonecastle Financial, which we externally manage. So Stonecastle Financial is a public company, trades on NASDAQ under the ticker BANX, B-A-N-X. It is not a subsidiary of Stonecastle Partners. It is a freestanding publicly owned company, but it is managed by a subsidiary of Stonecastle Partners called Stonecastle Asset Management. So we have equity investments in banks, debt and preferred stock in banks, and several $1 billion of cash deposits in banks on behalf of our institutional, high net worth, nonprofit, municipal corporate customers.
So this new vehicle, Stonecastle Financial, has a product in which it is investing in community banks. Could you tell us a little bit about this product?
Sure. So Stonecastle Financial was 3 years in the making. Anytime you try to do something new, it takes a little while. It seems to, at least. And the view was back engineered. It took sort of an old management consulting approach of the best product is one your customers tell you they need. And I went to regulators, banks, and investors and said, when it comes to investing in community banks, if you gave me your wish list, what would be the attributes you would want? Funny enough, banks and regulators were not terribly different from one another. They both want permanent, passive capital, and while regulators are less sensitive to the cost, the banks said at a reasonable cost. So that's their dream list, permanent and passive. When you go to investors, the number one thing that comes out, and funny enough, it's not return, it's liquidity when they think about community banks. A lot of institutional retail investors like the idea. Almost everybody knows what a bank is. Not everybody knows what a semiconductor company is. But when they think about the opportunities they have or have had to invest in community banks, many have been scared off by the fact that it is typically very illiquid if it's not a publicly traded company. And with about 6,800 banks left in the country, 90% of them are private. So that's been the challenge. So when we said, okay, if the issues are they want liquidity, diversification, current cash, because most bank investors do like dividends, what would this vehicle look like? And we ended up with the view of a permanent vehicle. And the only permanent vehicle is one that's publicly traded. And we went through the time to set up Stonecastle Financial as an SEC-registered investment company. So actually not a new structure. It's been around since the 1940 Act was written, but it's rarely ever used. It's a 40 Act investment company. So it's publicly traded. And now investors can worry less about getting in and out of a specific bank and can have the daily liquidity of being able to buy or sell the stock of Stonecastle Financial through selling and buying the ticker banks to change their exposure, to shorten it. They can even margin it, right? It's just a publicly traded stock. So if they want to margin it 50%, they can effectively increase their returns higher. The focus of Stonecastle Financial typically, though, is preferred stock. Maybe straight preferred stock, convertible preferred, preferred with warrants. Could even be trust preferred for smaller banks. I'll explain that in a moment. But the view is when you're a hedge fund or private equity, you have capital of which the investors who gave you that capital have an expectation of a pretty high rate of return, right? At least teens, if not 20s, and for private equity, probably 20s to 30. That's the expectation of the person who gave that manager money. And both of those vehicles, if it's a hedge fund, there's probably periodic liquidity, could be every quarter, 6 months, or a year. And for a private equity fund, it's typically a defined life. Could be 5, 7, or 10 years, but at some point that fund liquidates. And that means that two things that don't work well in the bank world, a forced exit and a very high rate of return. There are about 6,250 banks today in the country that are profitable and well capitalized. And funny enough, the average ROE from those 6,250 banks is about an 8.99% ROE. A lot of people find that shocking it's that high, but that's empirical data. That's just a fact. So most of the industry is doing okay. The banking industry is a bit tepid on growth because there's not a lot of loan demand because the economy is still sluggish, although the Dow seems to have defied that. I don't really understand that component of it. But if I can go to a bank and simply want to earn a 9%, and they're generating 9, in fact, there are over 6,000 of them generating a 9, I have a pretty good chance of making a 9. But how do I make a 20% rate of return? Well, the only way I can do that is to buy a bank stock cheap or buy it fairly priced and see that bank grow and expand its valuation. That's hard to do. It's not hard to find a bank that wants to grow, repurchase shares, maybe refinance TARP or SBLF, and is willing to issue a preferred stock at a reasonable rate, not cheap for them, but not expensive for them, fairly priced. And I can earn for my investors that 8, 9, 10% year after year after year. And frankly, I don't want an exit. I don't need an exit. The bank will pay me 9% or LIBOR plus for 10, 15, 20, 30 years. That's what we want. Nice, steady income. The warrants or equity options we get with some of these banks give us a little bit of the upside. We're not going to make a 20, but maybe that 8 or 9 becomes 11 or 12 or 13, which frankly for this type of exposure, very diversified, healthy community banks, it's a pretty good return.
So how long is the investment horizon then for a typical investment that Stonecastle makes?
Indefinite. I know that sounds like a cop-out, but it's really true. Of the 430 banks I've invested in the last 15 years, totaling about $5.6 billion of capital, I have never sold one. I've been redeemed out of some of it from banks that have paid off. We're a very long-term investor. We believe in the stability long-term in the banking industry. It's one of the oldest industries in the world. So I know it sounds like a bad answer, but it's really the truth. We have no expectation of needing to exit. If there's an opportunity, the bank goes public or it's bought, then either the trust preferred stock or equity could be assumed or amalgamated. But we typically, unless there's some really specific reason to try to exit, we have no intention to exit. We're just a very long-term investor and want to create a long-term stream of income and capital gains for our investors.
But your investors can get out because the stock is publicly traded and on NASDAQ, and there's a market for the stock.
That's exactly it. We've transformed. And funny enough, this isn't the first time that's been done. Right, John, if you think about the real estate world, go back to the 1960s and 70s, if you wanted to invest in a building, it was like a partnership, right? You owned a piece of a building. Then in the 70s and 80s, private REITs came out. Right? Remember those? Those were the early ones. These were not publicly traded, but it was a real estate investment trust where one or more properties were in a pool and you could own a fractional interest of that pool. And by now creating a fractional interest in diversification, the expectation of return from an investor dropped a bit from a single investment. And then when REITs went public in the 80s, 90s up to today, you've now transformed the same asset into a form that a retail investor or a pension or foundation can own and freely trade, and so their expectation of return went down even further. So you're taking the same yielding asset and transforming the form, which makes it more valuable, hence people will own it at a higher price and a lower yield. It's really the same thing we're doing to banks, is we're taking banks that have been very stable long-term investments but illiquid and turning them into a freely tradable liquid form, which allows investors to own them more broadly, increases the investor base, and hence effectively increases the value of that investment.
As far as the investments you're making, could you tell us a little bit about the typical investment size, and then we'll talk about the criteria?
Sure. For Stonecastle Financial right now, it probably ranges from, could be as small as $500,000 up to 5, 6, 7, 8 million. We might do 1 or 2 pieces, 10 or 15 million, but typically it's reasonably granular. The banks that we're looking at, as we had said in our prospectus, they range from banks of a couple $100 million in assets, and on the large end could be a few billion. Probably, for the most part, above a few billion, these banks could have public access or capital markets access, so they're not going to be the best suited. Doesn't mean we won't do 1 or 2 if there's an opportunity, but typically it's going to be smaller banks. Banks that don't have as easy access to capital, not because of credit, just because of illiquidity and size. There aren't a lot of institutional investors who show up for a $3 or $5 million investment. It's just too small. So that's typically the size. Geography could be anywhere in the country. We typically avoid very hot markets, and we avoid very poor markets, declining markets, markets that are having recessionary trends, increasing unemployment, increasing bankruptcy rates, or or changes in home price or real estate prices that are downward. So we're looking for stable markets, but high growth markets, frankly, can be as dangerous because it brings way too much competition in the bank space. And then you become an overbanked situation that tends to lead bankers to do sometimes silly things, as we saw in Georgia and the Southwest going into this crisis.
So is the idea that all the investments or the vast majority of investments will be made in the next 12 to 24 months, and then it's pretty much petering out, or will there be additional capital deployed after the initial round of investments are made?
That's a great question. The expectation for this first round of capital that was raised, which was about $110 million of equity, and we can lever ourselves up to a third, so call that roughly about $150 million worth of dollars to invest. We will have that done based on our projections within a 12-month period, hopefully sooner than that. As we come to the completion of deploying this, if the market's receptive, it is the expectation of us and the underwriting group that we used originally to continue to go out to market to try to grow this as large as we practically can, which could be, as we've done in the past, billions of dollars. And what investors would get is an ever-diversified portfolio covering a real national footprint of the best-performing community banks. That's the goal.
Let's talk about potential proceeds. Can you give me an idea of acceptable or targeted proceeds for the capital you'd be investing in these banks?
In terms of the use of the proceeds?
Correct.
Well, there are typically three that come up the most. And it's about a third, so there's no 1, 2, and 3. It's to fund acquisitions. Clearly, if you're buying another bank, you think you're buying it cheap because you think that you're going to get more value out of it than that. If you didn't think it would appreciate in value, you probably wouldn't do the deal. So if you're assuming you're getting into let's say Bank A buys Bank B, and let's avoid a distress deal for the moment. That becomes a whole nother kind of question. But if you had a healthy bank deal, so Bank A buys Bank B, and let's say they bought it for 1.2 times book. Well, they're buying that because they think combined at some point in the future they'd exit at 1.4, 6, 8, or 2 times book. So if you're issuing common stock to fund that, you're giving away a piece of the upside by definition, right? It's a dilutive sale. You're giving a piece of everybody's shares to someone else. When you do preferred stock, all of that capital appreciation goes back to you as the common shareholder, and you're paying a fixed amount of cost for that preferred. And the preferred isn't necessarily sharing in that upside. So that effectively, even though it's equity as preferred stock, both for regulatory purposes and tax purposes, it's really leverage for a common equity holder, which is why if you look at the top 30 banks in the country, 70, 80% of them have preferred stock outstanding, not because it's inefficient, because it's an efficient structure. So for acquisition, that's one purpose, and it can be done very quickly versus going out and trying to do a small raise of 3, 5, 7, 10 million. 2, organic growth. A lot of small banks have capped as many local investors as they can, or they could do a little more. Maybe they can find another 1, 2, 3 million, but beyond that, they need another source of someone who would be aligned with the bank for the long term. And given that we're a perpetual holder in concept, we're very well suited to be a very long-term investor for that bank. The third one, which is a more fascinating one, is actually share repurchase. So as I mentioned, about 90% of the banks in the country are private. And the shareholders, which could range from a couple dozen people to hundreds of people, these banks haven't really been able to find a way to bring liquidity to their shareholders, as one, or two, if it's opportunistic, because maybe there's a shareholder that simply wants out, or estate planning, retirement, funds for a kid's college, they simply need to get out. The stock could be repurchased at an advantageous price, maybe not a fire sale price, but cheaper than the bank would inherently be worth. So maybe it's 0.8 book when it's really worth 1.1 times book. The problem with share repurchase is you really can't use retained earnings all that much. The regulators aren't too keen on that, so you need new equity to come in to come out. But if you're selling common for common, that's not really going to work particularly well, and it's hard to do in a granular way. We make effectively almost an equity line available for a bank, a preferred line, where they can take down an initial $500,000, right, of proceeds, and then use that to repurchase, and then in increments of 100,000 as shares come up, either in bulk or small amounts, can just sort of be available to take down, raise another 100, buy back those shares, raise another 200, buy back shares. So it really becomes almost a capital planning tool, like a contingent line, for that bank to have the availability to buy back treasury shares and then in the future, whenever they deem fit, they can resell those shares as common into, back into the market. But it's a very, especially where banks are trading in general right now, these private banks, the lowest price, price to book we've seen in 30 years, it could be a very good time for them to be able to buy back odd lot amount of shares rather than raising 5 or 10 million for a mass buyback. You can't really be too opportunistic there. But here, gives you the opportunistic flavor of being able to buy small amounts when they come up at attractive prices, which benefits all the remaining shareholders.
Sure. You did mention TARP or SBLF. Would that be an opportunity as well?
It is. It is. We did note in our N2 filing, which is the prospectus, that we had an agreement to purchase some TARP pieces, which we did, and that was mentioned. We can't really talk about what we've done since until we release our next filing. But the TARP and down the road, SBLF and other programs, because under TARP there were several programs, not just the CPP that everyone's used to. That's what they call TARP. We are definitely looking at those assets. Smaller banks have a hard time raising capital at a rate of return less than 9. So for many of these, even when the rate steps from 5 to 9 in the case of the TARP CPP or an SBLF, the 1 or 2% up to 9, they may not have a cheaper rate in which to refi into. So stepping up at 9, you wouldn't refinance at a higher cost. So either you'll keep that outstanding, or you may simply want the government involvement out if it isn't sold. You might want to replace that with a permanent holder at a comparable cost. So we are looking at that. We do own some paper. We'll be looking at more. But we're also talking to banks that would like to be able to take that out of the government's hands and put it into private hands rather than have it get into someone who could be unfriendly, like an aggressive hedge fund who might be thinking of how they could leverage that paper to make the bank do things they want. And that's usually not in the best interest of the banks or the regulators.
Sure. Could you elaborate on the types of banks that would qualify?
Sure. Boring is good. That's a very technical term. But I like boring. Been known to say that before. Banking should be boring. Right? The nature of it is that banks are supposed to aggregate local deposits and pool those to make business loans, real estate loans, and consumer loans. That's the business of a bank. We're not terribly comfortable with very high growth stories because usually to grow a bank much faster than the rate of loan growth in a footprint, so if a local economy is growing at 6%, how are you going to grow for 5 years 20% a year? I'd submit there's only 2 ways you can do that. Either you underprice your loans to steal it away from other banks, or you take loans that other banks are projected, probably bringing credit issues with it. It's just, and you can see that if you look at banks that had a compounded annual growth rate of over 20% going into this crisis, 80% of them failed. It's just an unbelievable skew. Very high growth banks typically find themselves playing a very dangerous game of musical chairs. On the other side of the spectrum, clearly we're not a big fan of turnaround situations. It's very difficult to fix a broken bank. The best way to fix a broken bank is usually for a healthy bank to acquire it. Doesn't mean you can't fix a broken bank, but you can't do very many of those deals, and you can probably get that color from a lot of private equity funds who were doing that during the crisis. Some of those deals will end up being historically looking good, and some won't be so good because it's very hard. So we
talked about in your publication. You talked about no major regulatory enforcement actions.
Yes.
So would that mean that a bank with an MOU could qualify?
Depends on the nature of the MOU. So typically if a bank is under a C&D, a written agreement for capital or asset quality or management problems, it's probably not the right time to come. An MOU, MOUs are levied quite frequently. So if it's an MOU because of BSA issues, depending on the nature, probably not a big deal. Or an MOU that we cited the bank, it didn't have evidence of flood insurance in place at the time it put a mortgage out. Those are not going to be as critical. If an MOU is about management issues, if an MOU is sort of lingering capital, that might be okay if our capital solves the problem. If it's an MOU still lingering because of asset quality issues that don't have a good rationale or story, that's going to be a case by case. If you don't have a regulatory issue, you're well capitalized, you don't have to be wildly profitable. We're not looking for maximum ROE banks. We're just looking for nice, stable banks. So we're willing to have a fairly broad realm of what I would say a prudent bank investor would say is a good-looking bank. Not an outstanding bank, and definitely not a declining bank, but we're looking for stable, healthy banks in footprints that are stable, which tends to be most banks, because the credit distribution in the bank space is pretty lumpy to the middle, right? There are very few way outperformers and actually very few really troubled banks. Most of them are average, and we like average.
Gotcha. I was looking at some of your minimum investment candidate characteristics from your fact sheet, and this sort of caught my attention. You are looking for Texas ratios less than 50%, commercial real estate less than 50%. Couldn't help noticing C&I as being less than 40%. Does that reflect some concern you might have about many banks shifting from a CRE-heavy focus to a C&I focus?
So that's a very good question. So the benchmarks that we put in there aren't really the criteria we're looking for as much as it's kind of a minimum criteria. So when it comes to, let's say, C&I of over 40, it doesn't mean we won't do a bank that's a heavy C&I lender. But something you just said is a big flag. If you're seeing a massive shift in how a bank has operated, right, that in the hedge fund world, you'd call that strategy drift. So if a bank has done a very good job and survived this crisis as a heavy resi and commercial real estate lender, and now you see them making a massive shift where they haven't done it very much historically. Maybe they had a 5 or 7% C&I concentration, and within a year it's gone to 40%, you should be concerned. Right? Doesn't mean that it could be a founded concern, but you should be concerned. Because the skills required to be a good business lender are very different than being a real estate lender, just like being an asset-backed lender. Right? It's a very different. You have to understand how to do receivables checks and inventory checks. It's just a different skill set. And the regulators have noticed that as well. So you don't want to see a bank migrating its business strategy overnight. Over time is good. But you want to look at, there are clearly certain asset categories that give us pause. A lot of construction, land development, of course, anything in the subprime realm. But in asset categories, if you see a bank that's 50, 60% C&I, that's a very atypical profile. Because when you look at 6,800 banks in the country, the general profile is not all that different. It tends to range at about 35 to 40% commercial real estate, 15 to 20% 1 to 4 family, 15 to 20% C&I, a little bit of multifamily, and then the rest is typically securities and cash. Very little consumer. It's a very normal profile. So when you deviate outside of that, it doesn't mean that we're not interested. We just have to understand, why are you running that business model? Are you staffed properly for it? Do you have the right capital and liquidity for it?
So are you avoiding then, you mentioned you didn't want to be in bad markets, but you didn't want to be in high growth markets either. So are you avoiding the South Floridas, the Arizonas, et cetera?
Well, you can't ever say entirely to avoid an entire blanketed area, but I would say we go into those areas with great caution, which maybe makes us a bit of a contrarian. But we've looked at things in the Atlanta area, but they have to have some compelling reason of why they will do well. Not just because if the first thing they say, well, we're in a hot market, I'm not interested. That shouldn't be your number one reason. It should be because we have an approach that will make us outperform in this hot market. Okay, now I'm interested. Tell me why. What are you doing? What's different? What's your different approach? Is it technology? Is it the way you deal with your clients? Is it the marketing approach? Tell me something that you have a hook or an angle or a unique capability or something of why you're going to do better. Because otherwise, if you're just telling me your market is hot, well, then I should invest in the biggest, baddest guy in your market. Why would I invest in you? Unless you have something special. When you get into the rest of the country, well, typically you don't have to be as outstanding to be a good bank if you have good market share and great customer loyalty and good local ownership. I'm happy to be part of that. But we come into the very hot markets skeptical. Not saying no, it's just I'm less inclined unless you convince me.
Sure. Talk a little bit about your investment process. How long does it take to contemplate and make an investment?
It somewhat depends on how fast the banks move with us, both on credit and documentation. On the short end, I'll give sort of the summary, and I'll give you a little bit of the flow of how we go through it. It's probably on the short end 2 to 3 weeks, and the long end 5 to 6 weeks, unless a bank particularly takes a long time. And we've had deals that have taken 4 or 5 months. That's very rare. We've also done banks in a week when it's been a pressing issue. An M&A deal came up immediately, or an assisted deal in the past where they needed some extra capital. So the process would be that a bank calls in, and By the way, they don't need to come to us direct. They can go through someone like you or through an investment banker they've used for 10 years. We're not trying to cut out people who have relationships with their banks or their advisors. I mean, we're just an investor, so they can come to us however they wish. But when a bank comes in and says, I might have an interest in raising capital, we usually have an initial call. Maybe it's half an hour, an hour. Tell us about the bank. What's the use of proceeds? What are you thinking? What's your business model? Just to get a little familiar. If it seems interesting, and we'll do a pre-screen before we get on the phone to make sure that it generally meets at least an acceptable criteria, so we don't waste their time or ours with a very troubled bank or something. We would just politely explain why we have concern. Once we've had that call and it seems like it's interesting, we'll ask the bank to fill out a due diligence questionnaire. And the reason we ask them to do the questionnaire is mostly for their benefit. Rather than having a 5-hour conference call, having done 430 bank capital investments over the last decade and a half, we tend to know the most common questions that we need answered that we can't get out of an FRY9 call report. So we'll send them this due diligence questionnaire, and they can fill it out at their leisure. And that's why I said it's partially dependent on the bank. I've had banks turn around in 2 days. I've had banks turn around in 2 months. It just depends on how quickly they want to move. So if they turn around that due diligence questionnaire and it comes back, it'll usually take us about 3 or 4 days to go through that. We'll do a local economic analysis, microeconomic, demographic analysis of what is driving their local economies, the markets they're in. Once we have formed a view, we'll form a committee. Committee gets together, reviews the package. If we think things make sense, then we'll get on the phone with the bank a second time to go through questions we have from the due diligence questionnaire. If those get sorted out, we're still feeling good, we'll ask to come on site for 1 or 2 days, meet with management, go through some credit files, we'll crack loan tapes, probably walk the market, see some of the largest real estate exposures they have physically, actually go out and see the properties, get to know a little bit about that market. And at that point, we'll give the bank a sort of a letter of interest with the indicative terms, and that's iterative, because they may say, well, we're under 500 million, and I would actually like to do a trust preferred still, and I'm allowed because I'm sub 500 million in assets, and we can do that. If they say they want to do non-cum perpetual preferred, we can do that. If they say, oh, well, can I get a lower rate? I'm willing to give away some equity options. We can do that. We're very flexible. But we try to use as standard documentation for these different templates as we can, because if we in a bank for a very small issuance are spending hundreds of thousands of legal, that doesn't benefit anybody. That could be for a $2 million issuance. That could be a significant portion of the proceeds. So we try to keep, as we have over the years, very standardized docs so that it can be efficient for everyone, for us and for these banks on a cost basis. And once the docs are approved, we fund. So as I said, that could be typically a couple of weeks. The longer end could be 3, 4, 5 weeks. But either way, call it roughly a month, month and a half is about the right process for a bank.
And what's the regulatory approval process typically?
Well, for preferred, that's actually one of the advantages. When you do a common equity deal, if you're over 4.9, it requires a change of control application. And for those of us who have lived through that, that is long and painful. When you're doing a trust preferred or preferred, it's actually a bench approval. It requires regulatory consent, but it simply, there's no form. You call your regulator, you say, we're thinking about raising 2, 3, 5, 7, 10 million of preferred stock. They probably want to see the terms. You give them a term sheet, and they would say you're approved. It's a very, very quick process. Usually happens within a week. It's just a much faster way than raising common.
Gotcha. Well, thanks for giving us information about the new investment product. Just wanted to kind of circle back and talk to you a little bit about the more macro banking environment.
Sure.
First off, on community banking, how do you feel that community banks can perform well in this environment? What are good community banks doing well in this environment? How can they be successful in a competitive marketplace?
That's a good question. I think a lead up to that question people often ask is, how small is too small? Right? But when is a bank too small to really be competitive anymore? And there's no single answer. I tend to have 3 answers. If a bank is operating in a very rural market, they could remain competitive at 100 million. If you're in a suburban market, it's probably 500, 600 million. If you're in a city, in a metropolis, Boston, DC, New York, Chicago, LA, if you're not $1 billion, it's going to be very hard to compete. Doesn't mean there aren't exceptions to the rule, but it's generally about right. So what I see as still the very positive nature in the community bank realm is customer service. Here's an interesting stat. If you look at banks between 100 million and 10 billion, right, which may generally be kind of the prototypical community bank, and there aren't very many in dollars amount of sub 100 million. There's about 2,200 banks, but they're reasonably small. That universe today controls about $2.9 trillion of our banking system. If I roll that back 15 years, guess what? The same group controlled about 2.9 trillion. Isn't that bizarre? It hasn't really changed, but the banking system has grown from about, if you go back to the same timeline, it's grown from like 6 or 7 trillion to 15 trillion. So it's not that community banks are losing the battle. It's just that their balance sheets aren't, as a group, aren't growing, but they still are controlling the same dollar amount of the system as they have. It's just that the large banks have become even larger. And as the large banks, like a JP Morgan, B of A, Citi, if you look at those organizations, in the past 30 years, inflation has gone up about 2.6 times, right? Sort of the value of a dollar, right? It's changed. Those largest banks on average have grown 20 times. So think about that, right? They've grown so much faster than the value of the dollar. Means that how could they possibly focus on the same size customer they did 20 years ago, 30 years ago? They can't. It's just not it's not efficient. At JP Morgan,
doesn't move the needle.
At $2 trillion, you can't spend time on mom and pop. You cannot. It's just you'd have to triple their manpower count, and they can't do that. So community banks, if you look at what they do and how they exist, and I always love this question, which is sort of what you asked, is how do these guys compete? They actually compete really well. They don't offer a broader range of services than money centers. They typically don't offer better internet banking technology, more ATM access, any of that. Yet, they earn 40 basis points more asset yield on their loans than large banks and take half the charge-offs every year for the last 20 years, including this crisis. So they're not taking more risk. How are they getting paid more while offering less? Customer service. Because people really want a bank that cares. And community banks, I've seen it for the last 15 years, they really care. And that's how community banks are winning the battle. People are leaving money center banks in droves because they just can't stand the poor level of service, the disregard, the overbilling, the fees. Where community banks say, I'm a long-term view. I'm a partner with you. I help put your kid through college. I help buy your first car, fund your local business. This is what they do. And that's why I love it. And what I love even more is for the last 15, 20 years, money center and regional banks have had a huge advantage, and that was the cost of technology. They could afford ATMs and ATM networks and state-of-the-art mobile banking. Well, if you're a believer, in sort of the Moore's law, and you sort of look at the cost of technology. So the whole nature of what cost $100,000 to provide a mobile banking solution a few years ago, believe it or not, costs like $10,000 or $15,000 today, and in a few years it'll cost $2,000. So smaller and smaller banks are much more rapidly adopting the same level of services that they can provide to their customers that the large banks had an advantage on for years. And there's really no more advantage beyond that, right? Once a tiny community bank can offer you free ATM access anywhere in the country, and mobile bank solutions, and electronic payment solutions, and remote deposit capture, what can B of A do that's different? What more can they? They can't. So the community banks have only things to gain, and the large banks really have only things to lose, including Volcker, who just put a bullet behind their ear. So if I'm a betting man, I like mean reversion, and I like asymmetric trades, and right now the big banks only have downside, the small banks only have upside. They can mess up, but really as a group, they have a lot to gain, and I'm a buyer. I love that. I think we're in the right cycle. There's a lot of consolidation coming. We're going to lose thousands of banks. Every other day now I see another deal done, and that pace is only going to pick up. But if we go from 6,800 banks to 6,000 or 58 or 55 or 5, it's still 5,000 of them. It's a lot of them. So as long as we can avoid the weakest and invest in the good banks or good banks that will be acquired, there's really just upside for us.
Sure. Well, you mentioned technology, and really can't talk about technology without talking about branches. Do you think we're way over branched and branches are going the way of the horse buggy?
No. I think that we are way over square footage on the branch. I think the model of what a branch is is and will continue to change. I think the pure internet bank, the ING Direct, I don't think that's the future in general. That's fine for a savings product, but not for a bank you're using as your primary, for your checking, for your business work, etc. If you think about the physicality, there's really nothing more sacred to people than their bank account, right? Their savings. And even the thought, right, even though everyone really knows academically that the FDIC is 100% insuring everything under $250,000, when the economy craters, people still try to pull their money, right? They're still just, I can't lose this cash. This is my most prized cash. I need this available. So not having a physical presence is quite a bit of a concern. And you can see that with banks like Bank of the Internet, NetBank that failed, and others. Very few have made it successfully doing that without paying exorbitantly high rates, because people like still to walk up and kick it. But the problem is you don't need a 5 or 10,000 square foot branch anymore. That is the relic, and I agree. Today with Cisco telepresence, with internet banking, with iChat on your iPhone, you could do the same level of customer service with the bank without having to have the same level of brick and mortar, and you can do it more efficiently. So let's say you're a community bank with 10 branches. And to have your small business specialist in every one of your branches, it's not very efficient, right? But what if in your main branch you could have a really overpaid, a well-paid small business specialist, and through Cisco telepresence that you put at every one of your smaller footprint branches, someone could sit at a desk and a full-size, three-dimensional person is sitting right in front of them. Of course, they're sitting at the central branch. And they can have a real-time conversation and do all of their business, but now you're stretching one person who can cover 10 branches at the same time. That's the future. That's how you're going to stretch it. You're still going to have some people physically in that branch, but you'll need less, and you'll need less square footage. And I think
smaller branches.
Smaller branches, and probably, I wouldn't be surprised if you see more smaller branches.
Gotcha. Let's talk about M&A. I mean, certainly there's been a lot of chatter over the last couple of years that there'll be a lot of consolidation in the industry, and certainly there's been a lot of deals announced, but at the same time, the pace of consolidation hasn't kept up with what some folks have predicted. Can you give me some thoughts on the M&A environment in 2014 and beyond?
Sure. Well, I think that one of the barriers to consolidation has been the issue of private versus public banks. So with 90% of the banks in the country being private, if private bank A wants to buy out private bank B, it becomes a very difficult proposition for the acquired bank, because now they're taking someone else's illiquid stock, of which by definition they probably own a minority of, and have no control. So at least before they had a voting seat or something, now they don't. So even though the transaction price could be attractive, the currency they get is about as valuable as art hanging on the wall, right? It's not a liquid security. And I think that's been a barrier to a lot of private bank mergers. We've seen an increase just in the last few months on public to private or public to public smaller bank mergers. But I think having the currency of a cash component to these deals, of which there was a deal I saw announced, I think Sandler had one last night, which was a partial cash and partial stock. And I think that's how a lot of deals are going to be bridged. The problem is, where does that cash component come for a small bank deal? It's very hard to raise 1, 2, 3, 4, 5, 6 million. So I think that's been one of the barriers, although the pace already has picked up. I'm hoping we're part of that solution by being able to make these investments, these preferred stock investments. It helps to effectively consummate deals that are stuck. So I do see that the pace will pick up, especially for the sub $100 million banks, and maybe even in some markets the sub 200 or 300 million, who are trying to compete in those suburban or urban markets, where they say to themselves, look, we can still make money, but we can't make the same ROE. We're fatigued. We just went through this crisis. We don't really want to pony up new dollars to go buy a new core system and new technology. They're tired. And when you think of the management teams and ownership and boards of directors of many banks, I think the average age of a board of directors is over 70 years old at a community bank. An average age of a management team is over 60. So you have a huge succession planning issue coming up, and I think that's going to drive a lot of consolidation as well.
Certainly. There's certainly been an effort to make the overall regulatory burden lighter for community banks. I've noticed that on every regulatory rule, there's a section on the applicability to banks under $1 billion in assets.
Mm-hmm.
I know you interact regularly with regulators. What are your thoughts on how the regulatory burden is being managed with the smaller institutions?
Well, from the time that I spend in the regulatory circles, every month it seems to be getting a bit better. The tone is okay, maybe we've overburdened. You saw this with Elizabeth Warren at the end of the summer, where she was very anti-all bank and came out very specifically saying the small banks weren't responsible for this crisis, and I think we have to revisit our regulation of how we treat them and even consider a dual banking system. That was quite a shock from her, and it was either yesterday or the day before. Cordray himself came out from CFPB and said that the new mortgage rules that he may consider exempting banks under a certain size. So I think you are seeing, slowly here, a pretty marked change in temperament, saying that maybe, given that small banks don't take the risk that the money centers do and serve a very important purpose of bringing credit to underserved markets, maybe we have to treat them not with looser reins, just not put the new tight reins on, because they, as a group, didn't do that badly in this crisis. So it's still overburdensome today, and I think any bank that says that they feel like it's burdensome is right, but I do think it's going to get better.
Let's talk about TRUPS. I know, Josh, that you're one of the experts on trust-preferred securities. There's a lot of talk about them in the news with the Volcker rule and the applicability of investments that are TRUPS. Can you talk a little bit about what TRUPS are, and a lot of our readers are very unfamiliar with this asset?
Sure. Well, it's funny. Trust preferred is both an asset and a liability, whether you're the investor or the issuer, right? And there's very often, especially in Washington right now, a lot of confusion because it has to be thought of very differently of whether it was an issuer instrument or a buyer's instrument. So let's talk about an issuer's instrument. So a trust preferred security is debt. Let's start with that. It is debt. It's debt for tax purposes. It's debt for accounting. The Fed Reserve in 1995 gave guidance that if this piece of debt had certain attributes, and the two most important attributes were the interest payments were deferrable on a cumulative and compounding basis, and it was the longest feasible maturity of which the market settled on 30 years, oversimplifying, that could be a component of a bank's regulatory capital. That would count as Tier 1 capital, but not core equity. Under the Collins Amendment in Dodd-Frank, it said if you're a bank between $500 million and $15 billion, you can keep your trust preferreds on your books and treat them as capital until they go away. If you're over $15 billion, within a few years, we're going to phase that out. And if you're still under $500 million, and you're somehow fortunate enough to find someone who would buy it from you, which didn't exist before I created these securities at Solomon in the 90s, you can still issue, believe it or not. So as an issuer's instrument, it is debt. It was always prudent for a bank that was issuing from its holding company to realize it was double leverage. But there's nothing wrong with having a little leverage. It's over-levering, right, which can be the problem. So that is what a trust-preferred security is. It's a 30-year piece of junior subordinated debt that has a regulatory standing as a piece of your equity. It is not equity. It is not equity for tax or accounting. So that's what it is for a bank issuing. As an investor, it's a bond. That's all it is. It's a bond. And it's a bond that has a period, which can be up to 5 years, where the bank could not pay you in cash and let that missed payment accrue and compound. So if it was a 10% rate, if they miss a year of payments, they owe 10% on the notional amount. If it was a $10 million issue, it's $1 million, and they owe you interest on the missed interest at the same 10% rate. So it's cumulative and compounding. But otherwise, it's debt. It's debt of a bank holding company.
What happens to banks that have been, you said you can defer it for 5 years?
5 years. The rule says 20 consecutive quarters.
Gotcha. Okay. So if a bank has is open and it's not at a risk of failure, but is not exactly knocking the cover off the ball, if they go 5 years without making these payments, And I mean, how do these situations get realized? I mean, do the TRUPS holders have any right to take board seats? And I mean, how do these situations get resolved if the bank isn't able to make those payments?
That's a good question. Well, it's hard to know how it's going to work out because the first ones that are going 5 years and coming to the end of that are just occurring literally in the past 6 months. So it's just now starting. And we'll see how each one plays out. But from a legal standpoint, just as the bank with one of its customers, when it makes a loan to a customer and the customer doesn't repay at maturity, it then has rights, right? Rights to accelerate, to go to court to sue for payment. And effectively, a trust preferred holder is the same. And it would almost be a double-edged sword for a bank to assume that its relationship with its lender is different than its relationship with its borrower, right? So if you've lent a bank holding company trust preferreds, which I do, and they go 5 years and don't pay, and at the end of 5 years they have to pay all missed interest and interest on interest to go current, and then they legally could go defer for another 5 years, but they have to go current after 5 years. Then I have the right to take them to court and accelerate and sue if they won't pay, just as they would pursue someone who's defaulted on a mortgage, right? They'll seize an asset. It's the same thing. So how that will play out, it's hard to say. But that is what the legal obligation allows us to do.
But you don't have any of the bank stock, so
nope.
I mean, all you can really do is force the bank to sell itself or raise capital elsewhere.
Correct.
That's interesting. Well, this has been great. I appreciate you taking the time, Josh. This was very informative. And anything else you want to add regarding Stonecastle?
No, we're focused right now in deploying this capital into good opportunities. So, if someone knows of a good opportunity or is a good opportunity, they should reach out to us.
That sounds great. Thank you so much, Josh.
My pleasure.